Let's set up for the trading week ahead. I'm Jill Malandrino for TheStreet in New York City with special guest David Peltier. David, before we jump into the week ahead, let's take a quick look at the 5-day on the S&P, and it's pretty safe to say volatility is back in the market.
Absolutely. I think when you look, when the dust settled on Friday, you're going to see like a fractional drop in the S&P 500. But really, the majority of that came on Friday, and a lot of that was even intraday action. So, if anything, when I look at the stocks right now, it seems like there is a lot of fluff. There is a lot of air right now when you kind of look at the charts and whatnot. So don't be surprised to see pullbacks like that, even if they happen on an intraday basis.
Let's take a look at the trading week ahead, and it's relatively quiet. The big event on Monday is going to be the Apple Watch event. Attention really has shifted to the FOMC following strong non-farm payroll data, as you've said. So the focus there is really going to remain on the commodity and FX trades because of the US dollar strength, which is why we've seen just about every other asset class down for Friday. And of course, the Greece debt repayment, because there still is no resolution there, and that could really impact the Eurozone.
Well, as we were trying to figure out why the market just tanked all of a sudden around 11 o'clock a.m. Eastern time on Friday, it was really the dollar. It's like, don't try and overthink it. It's because of the dollar. But then you look at the 10-year. In 1 week, we gained 25 basis points on the benchmark 10-year Treasury. But like you said, the one wild card out there, and it's been that way for several months now, it's not oil, it's what's going on in Greece, what's going on in Europe. Because in the overnight trade, where it seems to be that's where we get all the changes, we're not always getting changes on the intraday trade. Right. It's the big gap up, it's the big gap down. That's because of what's going on in Greece and the rest of Europe.
The earnings calendar is going to be relatively light, and it really is focused on retail, which will coincide with retail sales on Thursday. There's a couple of interesting names in there to take a look at, like Dollar Gen, which has been a pretty big speculation story. Same thing with ANN, ticker ANN. Finally starting to see some takeout speculation there as well. And of course, home builder Hovnanian, because the home builders have had quite a run, and analysts out there think it's really frothy at this point.
Yeah, it's really a mixed bag right now with the retail and the consumer right now. Because obviously everyone's paying less at the pump. Anyone that has to fill up their gas tank on a regular basis knows that gas prices are broadly, generally down over the last several months. But then you throw in a big wild card like what was going on with the ports out in California. And while you might not see it in this quarter's results that are reported, there's obviously some companies out there, and there's been lots of speculation, but no one really knows who's really going to be the winner or loser of this. I don't know, maybe it's Ross Stores when they get to buy all these things on clearance later on.
Let's wrap it up and take a look at a stock that we've been talking about all week, General Electric. You own it in Dividend Stock Advisor. Here's the 1 year on it, and it's been trading pretty much so above its 50 and 200-day moving averages. We saw some really, really strong bullish options action in the last week of February. But as a longer-term fundamental advisor, why are you holding on to this?
First and foremost, I really like the dividend yield here, 3.6%. And with the market, the broader market averages at all-time highs, it's very difficult these days to find companies that are growing their dividends and have a dividend yield north of 3%. Because I want to get a dividend that's better than what the 10-year is paying right now.
Are you concerned about their exposure to oil?
The concern, oil is definitely a potential concern, but what I like is the fact that management has quantified the risk there, and it appears to be manageable. So I think the company, it's already priced into the stock is what I'm trying to say. And I think that this is a good longer-term holding. And now that they're focusing on industrial side of the business, I think you'll see growth begin to accelerate at GE.
Okay, thanks very much, David. Great to have you back in New York with us.
Thanks.
For TheStreet in New York, I'm Jill Malandrino.